you can add into your component of that?
Oh, are you talking to me? Yeah, that sounds good.
No,
Yeah.
there's nobody else in my room.
Ladies and gentlemen, welcome to episode 23 of Rein It In. I got 4 sticky notes, but I got to say, today is a chart heaven of an episode. We got 24 charts total to take you through. Number 1, we're going to be talking about economic updates. Then we're going to take you into the real estate market update. Then number 3, we are going to do a condo price prediction. Patrick versus JG. Get ready for that. And then number 4 is going to be the best part of the entire show, where we're going to dive into the regional part. And we're going to show you some brand new artificially intelligent technology that you've never seen before to show you how regional the market really is and what you can do about it. So strap in, get ready. It's going to be a great show.
No, not great. Epic. Hey, JG, before we get started, let's do a little bit of a public service announcement, but it's not really a public service announcement. It's a request for our viewers to like, to subscribe, hit the bell for notifications, to comment, tell us what you like, even tell us what you don't like. But we want to hear from you, and we want to build this channel and grow this community and deliver amazing content that really benefits you. So please like, subscribe, share, comment. That's all I got, JG.
Patrick, let's dive in. I'm gonna start by rolling up my sleeve. And the reason for that is because there's a lot to cover here today, and I don't want to be slowed down by my sleeves. All right?
Please.
So let's dive into topic number 1. We're going to be talking about a general economic update. But before we really get into that, I want to give everyone kind of a public service announcement around tax reminders. This year is the year in Canada, if you're a real estate investor, you have to file the UHT form, underutilized tax forms. They're a pain in the butt. If your accountant has filed your taxes already, they probably have done it. But if you file your own taxes and you forgot to do it, the good news is that deadline recently got extended from tax season 2023, which was in April of this year. It's got pushed back to October this year. So you now have a little bit of a window where you can do this. So just check that out if you're a real estate investor. You don't want to miss that, Patrick, because you don't want to pay unnecessary penalties for nothing.
Well, and I want to add to that, just because I've talked to a couple of members who had their accountant asking their accountant to do that work for them, and they got a quote on it. And not all accountants are created equal when it comes to filing those forms. So I want to encourage you to make sure you're having a conversation with your accountant. It should not be costing you a few $1,000s for, let's say, 18, 20 doors, 15 doors, 10 doors, whatever it might be. It's literally many accountants are out there just going, listen, you're a client, I'll do it for $50 a door kind of thing. I'm not saying necessarily that low, but don't overpay, because that has been happening. So I'm not sure what's going on in the accounting world, but it's not a standard cost.
Speaking of taxes, let's dive into part of that economic update, Patrick, for this particular show is the recent announcement just last week that the government's announced they're removing GST on new capital investments in affordable rental housing. And break this down, we actually have a really cool chart and a graphic to show essentially what this represents. Because I think the first thing everyone kind of jumps to is, oh, does that mean property's going down 5%? Am I going to save 5% on everything? The answer is no, it's not quite that good. So kind of break this down for us in terms of what we can expect people are going to save as it relates to this new waiving of GST.
Well, I don't think we can say what are people going to say when we have to look at the builder and say, what are they going to save? And, what this is going to do is probably offset some increases in wages, for example, or some supplies. I don't think there's going to be a huge, the intention of it is, I think, good. It's, to incentivize builders to keep going, bring their costs down a little bit. But depending on the builder, depending on what they've got going on overall in their operation, I don't think it's going to net out to a big number. I mean, some are saying as little as 1%. Some are saying it's not going to make a difference. So it depends on how you view it. And some analysts, if you will, are saying, no, this is a great move by them. And I don't disagree, but I don't think it's as big a move as they're making it out to be, which is often the case. They're kind of overstating it. But I mean, you look at it for yourself. When you look at yourself as a developer, I mean, what is it going to do to your bottom line, do you think? I mean, it's helpful, but it's not going to be a game changer.
Well, it's not going to be a game changer, but I do agree it's going to relieve some pressure, no doubt about it. It's definitely going to help with with some of that upwards price pressure, it'll give that, I think what it will do, Patrick, is I'm not sure prices are going to come down. What I think it might do, I know for us at Vistra, for example, if I really dug into the numbers, I think what would happen is you would see, okay, less pressure to raise your prices. As a result, you can kind of stabilize your prices. And that would be a good thing for things like inflation if we could stabilize the prices. But listen, the rule is that they're just coming out with is there's no GST, which is 5%, on all materials and services. Listen, there's a lot of materials and services in a build. And saving 5% on all of that is definitely going to have a material impact. Now, is the government overstating the success of it? Of course, that's their job, is to sell the crap out of it, and so they should. But I do think that what I like about this, though, Patrick, I'll tell you from my perspective, A, as a real estate investor, B, as someone who is at the effect of a lot of this, it's actually, in my view, the proper incentive. It is an incentive that is driving the market in the right direction. And I think that this is much better than other kind of rebates and stuff that's very difficult for people to cash in on. This just applies across the board. And this, for me, is a good incentive that I think a lot of people can capitalize on. And it's going in the right direction. Is it the perfect incentive? No, but I don't think a perfect incentive exists either. What I do know, for me, it's an incentive in the right direction.
Well, there's a couple things around it. I mean, we don't need to beat this to death, but it is also based on property type. So when you look at the scope of rental properties are already on the incline. So in other words, their building has been increased. When you look at multifamily apartment type buildings, they're on the rise. That's actually some of the primary construction that's going on. So, but it doesn't apply across the board to all multifamily, for example. So we just got to be a little bit careful about what it really drives. I think that as we go through the segment, we'll start to see where what the government is intending to do is get housing and get people building and builders on board to increase supply. I mean, the intention's there, but I think as investors, we have to look at it and go, what is the impact of that? It's going to take years and years to really to notice a difference in terms of what we've got for the supply side of it. So I think it's a little bit, some could say too little, too late, but ultimately they're going forward. They have an intention of getting supply out there. It's just going to take a long time to feed through. This is one thing. There isn't one solution to supply. These are little incremental changes that can be made.
Yeah, there is. There's no doubt. It's always too much. It's always too much too late when they're making the changes on the way up, and it's always too little too late when they're making the changes on the way down. So you can expect that's going to continue. That's just the way the government machine works. But to me, I think it's a good step in the right direction. I'd rather have this than not have this, which is good. Could there be better incentives? Sure, there could be, and hopefully we get more down the line. Interesting to see how this is going to go. So that's a really good start for real estate investors.
Yep.
Now let's transition to consumer price index. Here's kind of the general market feeling. I've been on the phone all morning, in fact, with various investors, and here's a general market feeling. Early September rolls around, and good news, the Bank of Canada decides not to raise rates. So the kind of market kind of goes like, oh, right. Like, I mean, emotionally, I'm not saying pricing. I'm saying emotionally, the market starts to go up and people are starting to think, oh, this is going to be great. We're going to go on a bit of a run here.
Good news. There's a report on TV with some very bad news.
And then not 2 weeks later, we get that the consumer price index has come out. And it was 4% year over year. And I just felt like yesterday when this headline hit the news, I just felt like the air come out of the tires and everyone's emotions went, poof, no, this means they're probably going to raise rates at the end of October. The good news is we're going to get the next inflation reading, I believe, before they make their decision to raise rates in October. So hopefully we get some good news. But this is where it's at right now.
Well, I think there's no surprise that it's come up. We've talked about this several times, that inflation is not, as much as they making it about interest rates and consumer and housing and all the rest of it. Central banks are hard pressed right now. They're not going to control inflation because they can't control oil prices. And, we've talked about this many times, JG. When we look at what's happening in the market, oil continues to rise and it will continue to rise, which is going to drive transportation changes or charges, which is, the cost of fuel, the cost of transportation, which affects the cost of food, and that's the biggest impact. And certainly some of the cost of goods that it takes to manufacture and or to operate, including inventory. So the point of that, what I'm making there, is that inflation is not going to come down in a meaningful way for a very long time. I would say that if they raise rates, here's where they're stuck. Here's where Bank of Canada is going to be stuck, is that if they raise rates, it's not going to impact food, it's not going to impact fuel, and it's not going to impact the cost of oil. We've got China right now, and let's just give a little bit of background on the oil. China is building their reserves. In other words, I think they got 1.2 billion barrels of oil on reserve that they've been accumulating over the past couple of years, whereas the US is kind of tapping into their reserves. They've got, I think, less than half of what China has, is some of the reports that are coming out, which is all to say that China has got their plans for whatever they see into the future. It's impacting the oil price. As long as oil continues to rise, we're going to see inflation rise. Now, here's the thing that Bank of Canada is going to bump into. If they raise rates, which there's some risk of doing that, they're not going to have an impact on inflation. But what is already happening, businesses are slowing down. We're starting to see unemployment tick up a little bit. Not a big concern yet, but if you look into the future, you have to kind of say, where is this going given what's happening economically? So some would argue that we are already there, but I agree with one fundamental analysis, and that is I think we're heading into a period of stagflation where we will see unemployment rise, we will see inflation continue to rise, and
is that a prediction, Patrick? Do I got to mark this as a prediction moment? I kind of think it is. I kind of feel like it is.
It's not a prediction. It's a concern right now. I think that's a direction we're heading, given the trend of our economy. Gosh. And so will the Bank of Canada raise rates? They might, because, I just think they might. But that's the concern that I would have, is if they do raise rates again, we are destined for a period of stagflation, because raising rates is not going to change the cost of food and fuel and many cost of goods.
Stagflation is extended periods of stagflation, obviously are not good at all. But as the economy slows and as as we get back into balance here, I think a period of stagflation is actually inevitable. The question is, how long is it going to last for? And you hope it lasts for as little as possible, because stagflation means that the economy is shrinking, but inflation is going up, which is not good, because then the average economy, the average people is feeling it double, because things are going down as an economic output and prices are going up. So things are really getting pinched. The question is, I think it's inevitable. It's going to happen for a short period of time. I just hope it's as short as possible.
Yeah, and that's where we're going to go. So in the context of what we want to share today, what does it mean to investors? And I think that's what we got to get to from a real estate and growing your asset base. Real estate's still a great opportunity. We're going to talk a little bit more about it. You got to be more precise, but the opportunities are there. And I encourage people, don't get scared off the field.
We will tell people exactly what they could be doing towards the end of this episode. So stay tuned, folks. But Patrick, I want to say one more thing about inflation, which, I hate talking about inflation. It's so boring to me. I could literally just curl up and go to bed right now. But 4% of the 4%, report by RBC just came out, 25% of the 4%, i.e. 1% inflation, is caused by the higher cost of living, specifically in housing, which is caused by higher interest rates. My point is the Bank of Canada, as you've pointed out before many times, is fully responsible for 1% of this 4%. If it wasn't for the higher interest rates, it would be 3% inflation, not 4% inflation. The RBC just came out with that this morning, in fact.
Well, and to add to that, I talked about food and fuel and the cost in rising, but also it's impacting the cost of rents, because of course rental housing providers, investors are having to pass on those increased costs, including interest costs, and interest is about a 30% of CPI. The point is that rents are rising. And also what we're starting to see, however, is they're starting to see smaller and certain markets are actually bumping up against the ceiling of higher rents. In some cases, they've come down. That was a recent report out of Kelowna, by the way. I don't have exact numbers, but in Kelowna, rents are actually coming down just a bit. So it's softening. So it's an interesting dynamic that's happening in different centers across the country.
And actually, in a couple minutes from now, we will cover the regionality of real estate, and we'll show people through some incredible technology that you can now see the regional differences between prices and rents and property demand and market conditions. It's pretty incredible. So we'll show you that in a second, folks. Now, Patrick, this here chart is the price of oil, just to kind of show essentially where it's been since I believe that's 2014. The ups, the downs, currently at 92.36 at the time we took this chart.
Yeah, and I spend a lot of time in this space and listening to any number of pundits. And although the analysis will vary depending on who and what expertise you're listening to, it all comes back to seeing that oil will continue to rise. Some are predicting very, very substantial rise in oil, well over 100. Some are suggesting even like into that $120 range. I don't know. I just know that based on what's happening in a global scale, when you see what's happening in China, Russia, even India for that matter, what's going on in the US, we're starting to see that oil will continue to rise. And I think that it breaking $100 a barrel is a kind of a almost, I would be shocked if it doesn't, and hopefully it doesn't, because that is driving inflation.
That's another prediction. I'm going to put another.
That one, I'm okay. I'm comfortable with that as a prediction.
We're gonna ask the video the producers here to make like a Patrick Prediction Index. We're gonna call it the PPI, the Patrick Prediction Index. And we've had two predictions here in this. Now there's more to come. We're gonna do another prediction on condo prices here coming up. So stay tuned, folks. Stay tuned. Patrick, this particular chart here I thought was interesting. Take us through it.
Well, this is really simple. When we look at bond yields, 5-year bond yields are kind of the benchmark for what's happening. They've spiked again, which is going to impact and has already impacted that 5-year fixed mortgage term. So this is, not good news. And some banks, I think, were up 0.45, and they're starting to have an impact on those mortgage rates. And this is really the tough one. Depending on levels of comfort, we start to see that investors are having, homeowners too, but people are having to make tough decisions. And ultimately that tough decision boils down to my payments are going up. So these are all things, again, that also impact the economy because there's less discretionary money to be spent. And we're starting to see, people having to get from underneath the weight of the payments that they're carrying. So these are all, this is just what's going on. And, again, I don't have any predictions for this. This is who knows where this is going to go.
And that, my friends, is your economic update for this episode of Rein It In. Now, as we migrate from the economics of Canada as a whole, which is kind of broad-based, really macro, which is what we were just talking about, let's jump in, I think, to the real estate market update because that's quite fascinating, Patrick. There's a lot of things moving and shaking in the real estate. We got some great charts to show in terms of where the market's going on different parts of the segment. Like, for example, construction, we got mortgage rates, we got amortizations, we got listings, we got all kinds of different things. And again, this update, folks, is relatively broad-based. We're going to be talking about provinces in general. So the economic update was kind of Canada as a whole there, which, as you know, as real estate investors, we're not really concerned. We're not as concerned with what's happening. I mean, we want Canada to do well, but what we really want is our region to specifically be doing well. So that's Canada. Now let's dive into a real estate market update, specifically on the provincial, Patrick. I think the first thing that's interesting is this. RBC came out with a interesting new report that says 43% of its residential mortgages have an amortization period longer than 25 years. That's as of July, and that's up from 40% a year earlier. That means 3%. It's went from 40 to 43%. But here's the kicker. It was 26% in January of 2022. That means it's doubled, just about doubled in terms of amortization. Now, we've been telling real estate investors actually for the last probably 6-8 months that this is what the banks are doing. They're not letting people go into default. They're raising amortizations, which is why you're not seeing a lot of defaults out there, but you are seeing amortizations that are lengthy. You had someone that used to have a mortgage for 18, 17, 15 years, and now their mortgage is re-amortized to 25, 28, 30. I have one mortgage up to 32 years now.
Wow. Yeah, I mean, this is the bank's reaction to it. And you got to look at it and go, the bank doesn't want to own your real estate. So they're going to do whatever they can to support you. Most banks will. There's going to be instances where you're going to hear stories about how they didn't do that. But as you look at this chart that you've got up, about monthly mortgage payments required to purchase a typical home. I mean, at the end of the day, you see a significant increase. And so let's just, we need to extrapolate on this though, JG, and remember that yes, payments are going up. We can talk about what it takes to qualify for a mortgage, but in this conversation, let's look at the cost of carrying a home, carrying a piece of property, going to drive rents from a landlord point of view, a rental housing provider point of view. But on the economic side of things, people have less income, less discretionary income because they're busy paying for a mortgage, paying for food, paying for fuel. That cost of living is increasing and discretionary income is going to shift. It already is shifting, by the way. And that, in fact, will slow down an economy. So back to interest rate increases, by the way, this is where Bank of Canada is going to have to make some tough decisions. And hopefully they make the right decision. And for me, the right decision is continue to pause and let this whole leg work through the system because there's a lot of catch up to do.
This is interesting though. What I love about this chart, Patrick, it goes to show, and you often say it in your own loving way because you're always talking so positively about the government. But what's interesting is oftentimes the government is, they try to do what they think is the right thing. And here's a good example of affordability was already at the midpoint 2022, as you can see in this chart, midpoint 2022, which is when rates started going up. That was the moment where people affordability was at its lowest, and their changes in the last 15 months has only done one thing, and that has made affordability even worse. And that this chart just shows you exactly that.
Well, let's just get back to what drove all of this to begin with. When the pandemic hit, they shut everything down, they flood money into the market. And of course, that is what we're paying the price for now. A total overreaction to what the pandemic was all about, the flooding of capital into the markets. I mean, that in itself is totally related to inflation, full stop. Point is that when we look at the cause, much of what the government is doing, or even the central banks are doing, and this is at a global scale, is really putting band-aids, fighting fires that they created, and they're running out of, I guess, tools to use. And so this is where it gets really kind of dicey of what moves will they make. But I can say this, is that if they don't get really clear on the lag in terms of letting things work through the system, I think we're in trouble. And I don't necessarily believe that they see it that way. So we'll see.
We'll see. All right, Patrick, here's another great chart actually about single family housing starts. Again, if people quickly forget, I know, and myself, yourself, everyone here, we forget really quickly, but it was in fact only in the early parts of 2022 when all these new government regulations were coming out. In Ontario, they came out. The federal government was spewing all these various things about pushing housing, and we thought, okay, we're going to go on a construction boom. We're going to go on a tear here. Watch the supply. Patrick, you and I were sitting on this very show saying, I don't think so. Wait until you see this will not work its way through the system. This is all just headlines. And now we're starting to see the realities of that, because look at single family housing starts, Patrick. They are down to a low that we haven't seen, ever on this chart.
Yeah, well, that goes back to 2010. So at the end of the day, we've talked about this many, many times. The government is not going to fix this problem, whether it be federal, provincial, municipal. They continue to get in their own way. And I don't know how they're going to deal with this. So we've got single family, and this is single family detached. And whether we look at it and say single family, it could be small multi, it could be a duplex, triplex. At the end of the day, the supply is not growing, it's actually decreasing. And there's a lot of reasons for that, not the least of which is the cost of doing business, the cost of materials. Don't forget, there was a time where builders had trouble getting supplies, and then they had trouble getting labor, and then there's of course the rising costs of capital. So I don't see this changing in a big way, in a big hurry.
I see your point.
So when we look at single family detached, and you and I have talked about this many times, is when we look at detached properties, that's the sweet spot for investors, I believe, to really capitalize and grow their portfolio. And whether they're buying single family and converting to a duplex or triplex, whatever that combination of things might be. Expanding on lots, as you and I have talked about many times, and you've done, is those laneway units. Those are ways to take this, because that's the gap. That is the gap that is needing to be filled.
And what's interesting is you see this showing up in the real estate investments in building construction. You can see that chart there. And this is going to work its way through. This has a lagging effect, Patrick. The fact that we're at an all-time low for building and for housing starts, this will have a ripple effect for many years to come, which is one of the reasons why when you speak as a real estate investor, if you're speaking to your broke neighbor who's like, "You're investing in real estate? Are you crazy?" This is what they don't understand, is the fact that we're at all-time lows in terms of housing starts, in terms of building construction. This is only putting upward pressure on prices in the long term. Now, right now, you have the influencer called higher interest rates, which is keeping things suppressed. But I think you're going to see an incredible bull run in the real estate market once the interest rates start to stabilize and once things start to flatten out. They don't even have to go down a whole lot, Patrick. I think that once things stabilize and investors start to feel like, okay, I can actually have a shot at this now, they'll figure out a way to make real estate profitable, because there's going to be a ton of upward pressure in the next 2, 3, 5 years on real estate. And I think you see it in those two charts if you're looking far enough ahead.
So let me break it down this way, JG, and yes to all of your points. And I think that you hit on something that we don't want to step over. It's a good entry point, which is in terms of interest rates are an influencer. Are they high? Yes. Are they going to get higher? Maybe. Are they going to stay high forever? Absolutely not.
No.
And, to that end, I'm in my own portfolio where I've had to renew some mortgages. I've taken short-term stuff. I've even had one that I left open because I believe interest rates are going to come back down. Now, do I think they're going to go to 2%? No, but I really do see them coming back into that 4% range over the next couple of years. But here's the point. If you as an investor can see into the future, create a thesis and go, something, I can live with this interest rate right now. I can live with, break even or minimum cash flow or whatever strategy you put in place. The point is that if you're looking for those great opportunities, those great deals, because there's more and more coming onto the market, you see the gap that needs to be filled. I think that, just by having some good planning and looking at what's really going on, and listen, JG, as well as I do, it's not easy getting capital for investment real estate right now from the banks. None of this is easy, which is actually what sets savvy, educated, sophisticated investors apart from everybody else. This is actually the time to get in and take advantage of those opportunities. That's what I got to say about that.
Well, Patrick, you say it's not easy now, and I agree with you, but it's never been easy, dude. You've been doing this for over 20 years. It's never been easy. It has been easier. Easier is not easy. It's only relative to how difficult it is maybe right now, but it's never been easy. And listen, if you're planning to make hundreds of thousands, if not millions of dollars investing your money, it's not going to be easy. So, there's an interesting quote I know you've shared before that says, like, for example, exercising is hard, but being super fat is also hard. Like, it's all hard. It's hard to be broke. It's hard to do real estate and to get wealthy and to secure your financial future. None of it is meant to be easy, but if it's a game you want to play, this very well could be an entry point. And you're absolutely right about that, Patrick. We'll talk about that in one of the later segments. So
and I want to say this. I just want to add to this. History proves that the herd is almost always wrong. I'll actually go out to say, inevitably, the herd is always wrong. So when the herd's going that way, you've got to clear the clutter, get really dialed into what's happening, and almost always go the opposite direction, or at least a different direction.
I had a mentor many years ago, a dear mentor, say to me, if everybody's going that way, I'm going that way. And that's exactly what you have to do. You often have to be a contrarian in order to be successful because, as you said, her mentality rarely works. So let's get through a couple more charts. Patrick, I'm just going to rip through these charts and you could speak to them real quick because we got to move this show along. So let's go with this one.
Well, no surprise here. We start to see BC home sales tick down a little bit. This is where we're starting to see that affordability continue to impact. When you slip over to Alberta, it's the opposite effect. We're starting to see home sales on the rise. No surprise with that because of the number of people that are moving in, the quality of the people that are moving in terms of income and ability to earn, and interprovincial migration. So in other words, they're not new immigrants. There are lots of new immigrants going into Alberta, but there's lots of interprovincial who are established in Canada. They've got a credit rating. They're actually going to another job so they can actually buy. So you're starting to see sales remain strong in Alberta given the economy that's happening there. Ontario home sales, like British Columbia, starting to tick down. Things are softer, no doubt about it. This becomes affordability because prices are up there. But JG, I'm going to state it again. We've said it many times. Both you and I have.
Well, you just said, hold on. You just said affordability because prices are up there. It's actually affordability because interest rates are up there because prices have come off their highs by in some markets quite a bit.
Yes, but when you look, we got to be careful about averages because we know that some of the prices come down are on the condominiums that also get logged, like they all get lumped into one big average. So we just got to be cautious about that. So we can clean that up. But you make a good point. The thing about Ontario home sales ticking down and affordability becomes the issue, whether it's the price of the unit or interest rates or a combination of all of that. What I'm saying is this, is that as rental housing providers, the point I want to make is that as costs are rising, there is many renters out there who have a very strong household income. In other words, they could have a couple $100,000 of a household income, but they don't have the down payment for a property. They can't qualify at the bank for any number of reasons, and they're renting units. And they're looking for what? They're looking for a unit to rent that they would actually want to buy as their home. So the quality of that home goes back to that detached unit is really in demand. So I just want to say that we have to realize that the quality and the demographic of what we're seeing as renters is really shifted because of this affordability issue. And that's the point I want to make kind of in here. So at the end of the day, things are coming down. Sales in Ontario for any number of reasons, and affordability, whatever makes that up, is a primary cause.
Listings, as you can see from this chart, listings have gone up for sure. They've gone up considerably in Canada. Now, regionally, though, things are a little different. We're going to show you some regional stuff in a second, so stay tuned for that. But active listings in BC have ticked up. Active listings in Alberta have ticked down. So you can start to see the different provinces and how they're moving differently. Again, even within the provinces, and we're going to dig into Ontario here and actually show you the different regions of the GTA. It's fascinating how there can be side by side. One's going up, one's going down. It's pretty crazy. We'll show you that in a second. Active listings in Ontario have climbed recently. So that's very, very interesting what's happening. And this metric here, Patrick, sales to new listing ratio, this is what they use to determine whether or not a market is a buyer's market, a seller's market, or a balanced market. And as you can see here, it's interesting what's happening, the difference between Alberta, BC, and Ontario, and where Canada fits into the averages in terms of if you average all the provinces. But here's a good example of why looking at averages just doesn't work, Patrick.
It doesn't. And this is really, when you look at sales to new listing ratios, there's no surprise that things are slowing down. But again, to your point, it's just everything's averaged in there, and you have to look at very specific markets. So sales to new listing ratios, this is one of the reasons that you're also starting to see the big predictions of a crash and housing's going to go to zero or drop 40% or whatever the number is in the bubble. That's just not true. What we do need to consider in this slide that you've just put up in terms of condo completions, well, guess what's coming onto the market? Aside from completions, JG, you've got a number of people that got into trouble. They bought those properties intending to assign. Now it's not assigning. So the condo market right now is a mess. And for predictions, I think the condo market, you're going to see, you already have, but I think you're going to see further price declines in many of the condo markets in the Toronto and GTA area for sure. Maybe not as much as in Vancouver because it's a different buyer. But
can we get some timelines on your predictions? So this is the condo price prediction we're making here, folks, live on Rein It In. We're each going to do this. We're going to have the PPI and the JGPI, the price prediction. So condos, you're saying prices are going to pull back, prices are going to decline. And you're saying that within which time frame?
I mean, listen, it's a guess at best, but I think that you're going to start to see definitely over the next 12 months, you'll see a slow erosion of pricing. And again, it's going to be specific to some Toronto condos, and but you're going to see the erosion for sure in pricing. And that's just strictly a number of units. I know a lot of people are saying, well, prices aren't going to come down. I disagree. I think in the condo market that those prices are going to come down. And a lot of that has to do with, number one, the volume that's coming on and the volume of people who are in trouble that need to get from underneath these deals because they bought with the intention of being able to sell at a profit and they can't. That's what I believe.
Now, interesting though, Patrick, I think so my prediction, by the way, is that we're not going to get price declines, but we're going to get slower price growth, much slower price growth. But that's going to appear in the headlines as price declines because they often do that. They mistake slowing price growth with price declines, which is not the same thing. So just keep an eye out for that, folks, because I do think, and Patrick, you and I both agree, that people will be yelling this from the rooftops, I think, during the winter season here when it starts to slow down, kind of that November, December, January, February. I think you're going to see a lot of headlines around this. So it's important for investors to keep track of that. But also the type of unit is really important, right, Patrick? Like you might have some really, really high-end condos that are like 3-bedroom, 2,500 square foot, 3-bathroom, used to sell for $2 million. They might come off to $1.5 million, but maybe that 2-bedroom, 1-bathroom, 800 square foot, that one may go up in price. So the point is that we just got to watch these numbers as the price start to readjust. You're not going to see all of them come down in price. You might see the average come down, or at least I certainly don't think they're going to come down, but I'm cautioning people to be careful what they're looking at.
Yeah, for sure. But there's a part of this that we, again, these averages and this big pot they throw things into. But consider that if the data is right, what they're saying is 30% of the condo market is owned by, we'll call them investors / speculators. And so when you look at that volume of people that are in there as investors and putting their capital to work and the exit strategy that they have in mind, there is a big chance that they're going to have to get from underneath those mortgages, because a couple of years ago or 3 years ago, no problem qualifying for a mortgage at 2.5%, 3%, whatever the number was, far lower than it is today. Now they have to qualify at double the interest rate, and they're running into some challenges with that. So that's why I'm seeing that they will panic. People will have to get from underneath it, and that always leads to discounted prices.
Now, here's some interesting updates before we wrap up this real estate market update. Vancouver has recently made some zoning changes, which I'm a big fan of zoning changes because this does have a material impact on builders' ability to get permits through. No doubt about it. This I'm a big fan of. So what's going on in Vancouver? Because Ontario went through this. And by the way, I've got a ton of coach homes on the go right now, starting to work its way through the system. And it's just beginning. I think we're about to go through a heyday in Ontario the next 5 to 10 years for coach homes. But I digress. Tell us what's happening in Vancouver.
Well, they did exactly the same thing in Vancouver. I don't want to say exactly the same. They basically did the same thing in Vancouver as what you have done in Ontario. This is not a provincial initiative. This is a Vancouver initiative and a Vancouver city initiative. So it is a big deal for Vancouver, and I think it'll have an impact. It's really going to depend on, will builders step up given the cost of capital? Can they get the ROI that they want? Can they get the labor that they want? And of course, there's wage growth that's going on, right? That they're fighting, and there's some headwinds, right? So there's a lot of things going on, but this is definitely a move in the right direction.
Stop being so pessimistic on it. This is a damn good thing, buddy. Enough with the pessimism. This is a really good thing. And I'll tell you, we're starting to have this happen though, Patrick, which is good, is municipalities are starting to up each other, which I like. So what happened in Ontario is the provincial government said, across all of Ontario, you have to allow a minimum of 3 units on any zoning. That's what happened in Ontario. Then Hamilton came out and said, okay, we hear you, province of Ontario. We're going to allow up to 4 units. So they upped the province. Now Vancouver's come out and said, we're going to allow up to 6 units or 8 if they're rentals on a single house lot. Hey, that is some serious density, Patrick. That's from 1 to 8. That's a huge difference. And that makes all the difference when you're running your numbers as a developer to be able to squeeze 8 units into something that formerly you could only do 1 or 2. Absolutely game changer. So I'm a big fan. And the fact that each individual municipality is starting to come out with this, we saw Edmonton do it. We talked about that, I think 3-4 months ago. So, I mean, this is great. It's moving across the system much faster than I thought it would, Patrick. And I'm a big fan. I'm all about the positivity here.
I get it. And I'm not that it's that I'm not a big fan. I'm looking at it and saying, okay, well, what does this mean? Well, for Vancouver City, it's a big deal. Got it. It's a population of under 1 million people. It's like 700,000 people. So does it have an impact on Vancouver City? For sure. But it's not a province-wide initiative. So that's my only point around all of that. So
Abbotsford will follow for, all the cities will follow, dude. They all got to follow suit. Or the provinces are going to do. You just wait. I'll make that a prediction that within 2 years, it's moving faster than I thought. So I'm going to say within 2 years, many of the major cities, and when I say major cities, I mean anything over 100,000 people, will come out with their own zoning changes that are going to help developers move in this direction. Now,
and they need to. But as investors, if you're worried about supply, oh my gosh, I got these rental units now, it's going to be oversupplied. This is years in the making of where it's going to change.
Yeah, that's good. I'm glad you brought that up, Patrick, because some people might be thinking that. They might be thinking like, this is going to be a problem for you. It won't be a problem for you, by the way. Let's look at the recent CMHC report that just came out that is predicting up to 4 million housing units. We'll have a shortage of up to 4 million houses by 2030. This is quite shocking. And a good thing for us real estate investors because it's price security for us. It lowers our risk and it tells us where we're going up to 2030. We're very safe.
Yeah. And this is always the data. So it goes always back to what we say. This is a great opportunity for investors to stay focused, stay mindful, be really diligent and kind of, we'll talk about it in a minute, but be very precise in their strategy and where they're investing.
Okay, Patrick, that wraps it up for our market update in terms of real estate market update in general. But there's more to come. We have to talk about the regional market update. And what I'd like to do now is introduce everybody to an incredible platform called DI Vault. DI-Vault. DI stands for Deal Intelligence. And this is an incredible platform. It's AI technology, artificially intelligent technology, which has predictive analytics and machine learning built into it. And I just want to show people that are watching, because we just gave you an interesting market update on economics. Then we gave you an interesting market update on real estate. Now let's dive into the different regions. Now, just look at the chart. Let me push this aside. Look at the charts. By the way, we put through the entire MLS inventory through this system. So we see all the properties. Okay. So this isn't like one-offs or so on and so forth. We see all of them. Right now on this chart, there's 7,611 properties that are visible on this particular chart. And you could see this is the cash flow. What you're seeing here is the cash flow possibilities in any particular market. The green markets mean that the cash flow is 6% or more. The yellow and orange means it's about 5%, and the red means it's 3% or less. Okay. So just have a look, Patrick. What I find fascinating about this is you really start to identify a couple things. You can see how there's different markets that are a lot better for cash flow than others, and that's fantastic. But as I activate different layers, like for example, the price change, look at this. This is so cool how in the last 30 days, Bowmanville, Orono is green, meaning prices have been increasing in the last 30 days, versus Oshawa right beside it. It's red, meaning it's been decreasing in the last 30 days. And then if you look at the Ajax Pickering area right beside it, look at this again. You got yellow, which means they've been neutral. They haven't went up or down in the last 30 days. And just beside it, again, they've been red. This is how regional real estate really is. So folks, when you're listening to market updates, whether it's ours or anybody's, you have to go dive into your regionality to see what's actually happening. Because as you, and watch what I'm going to do next, these are the 30-day price changes. Let me go to a 90-day price changes and watch how it all changes. Look at this. Boom. Look at Orono Bowmanville. They've been going up in the last 30 days, but their 90-day trend is actually going down. So really fascinating. And you could, if you had access to DI Vault, folks, which you can get access to DI Vault, you should, I don't know if we can include in this video or in the comments a link so people can discover the DI Vault and come to an information session. But this, Patrick, is the kind of technology investors absolutely must be using if they want to get into the regional market so they can understand what's happening in their market, not just across the province or across the country.
Well, this is, we've talked about technology so much over the past 4 years. And then when we look at DI Vault and what AI is bringing to the table, what technology is bringing to the table, it almost is feeling for us, because we're in it, is almost nonsensical to not use technology to source your deals, find your deals, negotiate your deals, because it's here, it's working. And for those of you that are looking at this, this is early adopter possibilities, but this technology is very robust already. We've used it extensively. We've had users use it extensively. And this is precision targeting your market and understanding what's going on in a neighborhood specifically, as JG's pointing out there. It's like you're like being a sniper in terms of what you're looking for, how you're finding it. And I can't say and stress enough, it's efficient, it's effective, it's fast. Clarity equals velocity, and this gives you the opportunity to embrace it fully. And I can't say enough about the technology in terms of taking your investing to the next level.
Folks, you got to come to an upcoming DI Vault information session. Find the link in the comments or in the description and get there, because Patrick and I are really behind this DI Vault. And the reason is because, check this out, you can actually see the rent changes. So look what's happening. Give you a perfect example. Look at the 30, let's just say you're interested in Bowmanville, okay? In the last 30 days, prices have been going up. Good to know. In the last 90 days, in general, the prices have been going down. Okay, might be the bottom of a market, might be a good time to get in. And let's look at what's happening with rents. I click on rents. Rents have been neutral in that area. Well, now you're starting to get a good sense of what's happening in that particular market. You're not looking at Canada wide. You're not looking at Ontario wide. Ontario is massive. I mean, what happens in all of Ontario has not as much bearing on what happens in these individual markets. And by the way, there's so many more different metrics you can put on and layers, and we'll show you all of that in the upcoming info session. So you got to check in on that. But I wanted to give people a bit of a preview, Patrick, because the regionality of real estate markets is incredible. And that is what investors have to be experts at, is their region. They need to know what's happening in their region, more so than what's happening with macroeconomics in general across the entire world. Real estate is very, very regional.
And I want to point out something here. When we look at technology, JG, we just keep beating this technology drum because that's where it's going. I say that this shift in terms of how investors can operate is literally, I think it's as big as going from snail mail to email and text. Like, I think it's that dramatic. And maybe it's not so dramatic today, right now, but that is where it's going to be in a very short period of time. And, embracing the technology is going to make a huge difference in the profits and your workability of a piece of real estate that you want to buy and invest in. It is that big a change.
The amount of time you can save and your level of efficiency and effectiveness is off the charts. Patrick, I was doing a demo for some investors yesterday, and we took 2,000, they were interested in London, Ontario. We took 2,000 potential listings that were on there. We immediately brought it down to, okay, let's look at London. We brought it down to 1,146 listings. We then clicked on the analyzed button, which then reduced from 1,146 to 825. And then we took those 825, we said we only want duplexes or triplexes. That reduced it down to 96 opportunities. And then we applied artificial intelligence to that and said, tell us which ones are cash flow positive of the 96. And it came back with 25. We went from 2,000 possibilities to 25, and we did that in less than 30 seconds. And then we were able to analyze all 25 of them in less than 15 minutes and start submitting offers. That's how effective and efficient this platform is.
It's spectacular. So anyways, not much more to say about it. Embrace technology. This technology is unbelievable.
So last but certainly not least, Patrick, I think we got to leave people with, okay, what should investors be doing in a market like this? What should investors be doing? And I'll kind of, because I'm in it really, really deep right now, in this world, not only teaching people what to do, but doing it myself, managing my portfolio and doing a lot of development. I got to say that I have never seen a better time in my last. I've only been doing this for over 10 years, so not as long as you, Patrick, but in my last 10 plus years, I have never seen a better time for what I'm calling surgical precision. If you know exactly what you want as an investor, you know what kind of property, you know what region, and you've done the work of educating yourself, then right now is an absolute incredible time. You have a ton of flexibility. You can submit offers. People are open to joint ventures. There's incredible opportunities out there if you have surgical precision. If you're just going to spray and pray and hope that you're just going to land something, that doesn't work. You got to be educated. You have to have taken a course like the Real Estate Investing in Canada course, which is 50% off right now. And you could speak to that in a second, Patrick. But when you become surgically precise and you have tactical accuracy, you can really be planning moves that I tell you in 5, 10, 15 years from now, you're going to look back on this moment in 2023 and you're going to say, I'm so glad we went through what we went through because it opened up the market opportunity for me. And that doesn't happen that often, Patrick. In your 20 years of investing, there were moments in time where the market opened up for you and you could dive in and jump deep. That's one of those times for the right person. If they're educated and if they know what they want, they can really pounce. That's what I think investors need to be doing right now.
Well, I think to your point, I mean, at the end of the day, what are we trying to do? We're trying to put capital to work, get a great return, own some hard assets. Part of what's going on right now, some investors are going, no, I can park it in a GIC and keep it really safe and, get 5% or whatever the going rate on GICs is. I don't know it. I know it's higher than it's ever been or has been for many, many years. So there's a propensity for people to keep their capital safe that way. But it's also,
But is it safe, Patrick? Let's talk about that for a sec. Is it safe? You're investing in a GIC at 4.35% and inflation is at 4%. You tell me what the return on investment is if you do that math.
Well, the return on investment is number one is inflation is much higher than 4%, regardless of what they're saying it is. We know that, and anybody that is really paying attention to what's going on economically knows that. How they rate that basket of good in terms of inflation is a moving target at best. So we think that inflation is probably even double, but that's a different discussion. The point is this: we want to put capital to work and we want to own hard assets. Is it a great return on your investment? Is it safe? No. You are actually still, even at 4.5% or whatever the number is in a GIC, you're falling behind. Is it better than nothing? Yes. But what's even better than that is getting your capital to work in real estate, in those hard assets. When you have that time frame of 10 years, 5 years, 7 years, that's where you need to put your capital. And this is an opportunity to do that through the confusion, through the uncertainty. Now, having said that, back to Real Estate Investing in Canada, that program that we offer, it's all about education. And what intimidates people is they don't know. A confused mind says, no, get the knowledge you need. REIC, or Real Estate Investing in Canada, our program educates you on how to do that. It's world class. We just updated it less than a few months ago, and it's current, it's applicable, it's step by step, it's a system, it's a process. Put your capital to work in real estate, and it works for you.
And by the way, folks, over 200,000 people have been exposed to that very course. And the knowledge that you're going to learn in that course has represented over 5.47 billion with a B, $5.47 billion worth of deals. So absolutely incredible knowledge in that course. You got to take that course if you need the confidence, if you need the education, take that course. If you know what you're doing, though, my gosh, DI Vault is a place for you to go because you need that technology so you can move faster than ever before, and it's going to be easier than ever before and quicker than ever before. And I'll just leave people with this, Patrick. This is a snapshot of a development I'm currently planning. I just got this yesterday, these designs here, but this is a development we're planning. And Patrick, I think back to, if anybody knows me, Patrick, you know me best here, but I eat my own dog food, this is what I'm spending my time, my day, and I'm putting my money to work is planning these kinds of developments in order to move forward so that in 5, 10, 15 years, these developments are built And even though the interest rates are higher today, you're not going to see those interest rates stay high forever. And in 5, 10, 15 years, we're going to be having this conversation. I'm going to say, my gosh, I'm so glad I did that development in one of the roughest real estate markets. By many standards, people think this is a rough market, but if you have the right attitude for it, you're actually going to find out this is a golden opportunity. You just have to look at it the right way.
Well, and JG, I want to be clear on something here. Number one, we don't sell real estate. So we're actually drinking our own Kool-Aid. We're putting our money to work. We're doing what we're actually teaching and educating people to do. We're not suggesting people just throw money up against the wall and hope it sticks. Be precise, be strategic, be intentional, and you'll do extremely well in this real estate market right now. A huge opportunity.
Ladies and gentlemen, that completes this episode of Rein It In. Hopefully you've enjoyed episode 23. Please tune in for episode 24 and beyond. And please like, subscribe, and comment below, and we'll see you on the next episode.
Thanks, JG. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click there.